right. Thanks everyone for coming. Hello to our live Facebook audience. Thanks for coming as well. Today we are talking in week 6. I can't believe it's week 6 already. We only have 2 more of these in the series, talking specifically to small business owners. So welcome to the Paradigm 360 Small Business Summit. We're here because we work with small business owners every day, and we recognize how much small business owners have on their shoulders. Whether you're a 1099 contractor and you're in charge of all your clients and all your inventory and all your sales, and you're keeping track of everything yourself, or you actually run a business with employees, excuse me, you're still responsible for making so many of those decisions. And in our day-to-day interaction with small business owners, we've realized that it might be hard to find an expert, someone who you can really trust to bring into your business, come alongside what you're already doing, and really enhance your offering and make sure at the end of the day, can you answer this question? Does your business take care of you? Does your business take care of your family? And if you aren't sure about the answer to this question, then this is exactly what we're here for, to make sure that your business is giving you the protection you need, income, free time, whatever those initial reasons you went into business were, right? So we're bringing the experts to your door, the sphere of influence, as we call it, and all of these experts are coming to you to provide just information to see behind the scenes and how they do business. And the best part is they're local to you here in Arizona, right? So you can work with any of these individuals very easily and ask them more questions and see if they might be the right fit to take your business to where it needs to go. I am your host today. My name is Abby Vick. I'm the founder and CEO of Paradigm Money Management. Like I said, I work with small business owners on a daily basis. Most of my clients are women, millennial, Gen X, so they're in the middle of their life, they're trying to start their business, they're trying to build wealth, and there's so many of these questions that come up in the meantime. So today we are going to be talking about coverage for the worst case scenario, right? So the worst case scenario, what could that be for your business? Closing your business? No, you're the one that's the center of your business, especially the small business owners that we know. And what we need to think about protecting is we're protecting our biggest asset. So some people don't think about income as their biggest asset, but it really is. If you're a younger person, if you're millennial, Gen X, whatever age bracket you're in, you could have decades of work still in front of you, and that's decades of income, years of income, and that's your biggest asset for most of our clients. And of course, how can we bring peace of mind that no matter what happens to that biggest asset, we can take care of our family, we can pay our bills, we don't have to, might not have to even change your lifestyle if you want to plan that way. So I'm not going to give away the whole thing, right? Because we have our expert here with us, Charlie. So thanks so much for coming, Charlie. He is an insurance broker at Mass Mutual. So as we learned earlier, brokers have access to lots of different companies. They're not just selling one product. They're not married to one company. They have access to several. Charlie works with business owners and local Arizona families. He works in lots of different areas: student loan refinancing, retirement planning, financial education, and today we're going to be focusing a lot on insurance strategies. So again, not focused on one product. This is not a product sale where we're going to focus on one thing that could be perfect for you. We're not talking about that. Today is all about how you can use insurance in a variety of ways to really help you and your family, because it can so be customized to you. And of course, Charlie's goal is to help you reach your personal financial goals. So he gets to know his clients really well to do that. So thank you, Charlie, for coming. Here's all his contact information, and it'll be on another slide if you can't jot it down at the moment.
Thanks for having me.
Yes, I'm going to stop sharing my screen so you can focus on our faces. We're going to have an interview today. And so, Charlie, the biggest question, right? Why do I really want life insurance?
Well, I'd say that the short answer is to pay off debt and replace lost income, right? But there are a few different policies that a business owner in particular should have in place, or at least consider putting in place. We'll touch on those a little bit later in our conversation, but basically as a business owner, you want to think about protecting your family, your partners, if you have any, and the business itself that you've worked so hard to cultivate over the years. Again, your family is dependent upon the income that your business produces for their very survival. So a couple of items to consider. You may have taken out loans to start or grow their business that are backed by your family's personal assets. Your successors may or may not be equipped to take over the business after you're gone, really to no fault of their own. It's just that may be the situation. And they also may not be able to sell the business easily or be forced to too quickly, to sell it too quickly, kind of at a drastic discount, just to make ends meet in the short term in the absence of the death benefit proceeds that be provided by a life insurance policy. So any of these scenarios could have a major impact on your family, right? It could easily equate to a loss of your primary residence if that has been put up as collateral on a business loan. So these are just a few things that every business owner should take into account and protect against.
Yeah, and I think what's central to that is there are so many businesses that are service-based businesses, right? So I have to be present to make a sale. I have to be present to make income. It's based on my, relationship to my client. And of course, if I'm taken out of that equation, how is the business going to continue to bring in revenue? So
exactly right.
Yeah. Okay. So how much do we really need? I mean, of course, from the financial aspect, we're trying to keep all our expenses low, right? So just adding on insurance to add on insurance is not something we're about. So let's try to think of it a little bit more realistically on how much you need to help your family sustain their lifestyle after you're gone. And I have a slide for this, so let me pull that up.
Sure.
Okay, go ahead.
All right, so really like the simplest way to calculate what your need could be is to just use basically a straight income replacement process, right? So you take the primary breadwinner's current salary or their projected salary over time, if you have an idea what that might be, and then just multiply it out by the remaining amount of years that they have until they return for their retirement. So here in this example, you see Susan is a married mother of two. She's a 35-year-old business owner who earns $165,000 a year, and she does plan to retire when she's 65. So it's a pretty simple math equation. You take 165,000 times 30 years, and that equals 4.95 million in coverage. So that is a very simplistic way to go about, just think about what kind of coverage you might need, really just from an income replacement standpoint.
And this is probably the one that people are most familiar with because this is how like group life insurance is calculated, for example. If you're going through your employer, and I know we're going to talk about this later, but if you go through your employer and they want to replace your income for 1 year, maybe 2 years if they're being generous, then you can multiply on that. But I think this gives you a more tangible number to say, I know, how many years do I really want to replace their income, need to replace their income? And this is a really good place, a starting place to see what kind of coverage you might want. All right, you want to talk about the other option as well?
Yeah, absolutely. Here, in option number 2, I like to use the acronym LIFE. Just is kind of easy for me to remember, and I think it is something most folks can kind of relate to. The acronym itself stands for, the L stands for liabilities, the I for income replacement, the F for final expenses, and E is for education. So here in this example, we have Jerry, who is also married, the father of one 9-year-old. He's also 35 years old and owns a business and earns $130,000 per year in salary. Jerry does plan to retire when he turns 65, but along with these other considerations that we've kind of mentioned here below so far, he and his wife believe that 20 years of income replacement is enough coverage for them. So, you run through and you think about what your liabilities are. First off, usually most people's largest amount of debt comes in their mortgage if they're a homeowner, right? So in this case, Jerry and his wife have $275,000 left on their mortgage. They have $25,000 collectively left in student loans, one $15,000 car loan, $5,000 in credit card debt, and sum all those up, and that equals $320,000. Okay. So then we'd move on from liabilities to I's, income replacement. As I stated before, Jerry and his wife decided that 20 years of income replacement was enough for them. So you just take 20 years times 130,000, that gives you we got 2.6 million plus 320,000 so far. Then the F stands for final expenses. Now, this is usually recommend folks do maybe $25,000 or so for a traditional funeral. A traditional funeral with an open casket is far more expensive than, let's say, if you're just going to go ahead and be cremated. But there are other final expenses other than the actual funeral itself to consider. I mean, maybe you have a celebration of life service, or I don't know, there's some other outstanding, debt obligations or hospital bills that you might need to take care of. So all things to consider when you're talking about the final expense category here. And then E, finally, is education. So this one I find that people are kind of all across the board here. It's a very personal decision. Many folks, they maybe didn't go to college and they've been quite successful without a college education. So maybe they don't see the value in it. Or perhaps they see the value in it, but they had to work their way through it themselves and didn't really have anybody help them through it. And that's, they learned some very valuable lessons, working hard and, staying diligent, through that process, and they want their kids to have that same opportunity. So maybe they, don't provide it, include this in their life insurance policy for any coverage, or some folks want to just, cover a portion of it. Some folks want to cover all of it. So at any rate, for this example, we're just using, currently, if we project out over an in-state tuition 9 years from now, the cost of that for a public in-state school is going to be about $100,000. So that's what we plugged in here for the education piece. So we sum all of those up, and that total coverage amount comes to $3,095,000.
Yeah, and these numbers on first glance might look really intimidating, right? I'm looking at a $3 million policy. I mean, how am I going to afford that? But I think walking through this coverage example, you realize how valuable your income really is if you think of your income as an asset, right? So his income alone in this example is $2.6 million. Does anyone have an asset that's 2.6 or more that they have? I mean, They probably don't. Their house is worth much less than that. So if you think about it in that term and you're thinking, I really want to provide for my family, that's probably the easiest example. I want to provide for my family. I want to make sure they're going to be taken care of. Replacing your income is a very large part of that. So yeah, I think this is a great example. The LIFE acronym makes so much sense in, you're really setting up whoever receives your money, you're really setting them up for success. They can pay off all their debt. They're not worried about bills for the next few years. Hopefully they can take care of all your funeral stuff and treat you well. They can invest for their kids' their kids' education. I mean, you've provided them so many opportunities so they're not devastated when a passing happens. So
absolutely. And to your point about, you look at some of these numbers, we're 4.9 million, I think, on the other previous slide, and over 3 million on this one. But if term insurance is, oftentimes what most people will lean towards initially, at least. It's actually pretty inexpensive coverage for that amount. Your premiums aren't that expensive every month or annualized, whatever you want to pay for them on a term insurance policy. So just something to keep in mind without getting too much into the weeds.
Yeah, and I think the important thing to remember is, I've heard some people say, well, I'll save for that. I should have enough retirement savings for that. But on day one of buying the policy, when you make your first payment, you have this coverage on day one. So maybe your monthly payment for a term policy is in the hundreds per month, or maybe it's $50 depending on how much your policy is worth. But on day one, you make that payment. If you pass the next day, they are going to receive the money. So
that's exactly right.
How can you recreate that in any other way?
You really can't.
All right. I think that was a really good example. So why can you get free life coverage from a corporate job?
So, it's up to each employer on their own whether or not they're going to provide, their discretion as to what they decide to offer their employees as part of their overall benefits package. But I would say that the main reason for an employer to offer life insurance to an employee or employee base is they want to be competitive in the marketplace, and they're looking at hiring people and retaining good people. So that would be, that's kind of the company's first and foremost concern. I'd say to a lesser extent, their concern is about you and your family in particular. And for good reason. A business is in itself its own entity, and it needs to be treated as such, right? So it does make sense to look at it from a very much of a business standpoint. But yeah, it's really more for hiring and retaining good talent than it is for anything else.
Yeah, it's their objective is to retain employees, make an enticing benefits package so new employees want to come. And if they're shopping around, then they can compare the benefits package and pick the best one. But expecting your employer to have your best interest in mind as an individual, or to customize your benefits package for whatever your family needs, that's an unrealistic expectation.
Right.
And so it's nice that you can get some free life coverage, but you're really not retaining that, and it's just so they can brag that they have a great benefits package, to be completely transparent, right?
Yeah, obviously you want to take it. If the employer is offering it to you at a decent rate, it makes sense to take it, but it typically isn't quite enough, and I think we're going to get into that here next.
And they can really knock down that price because they're putting you in a group. And a lot of people in the groups, especially at corporations, are younger. So what's the statistical significance of a younger person dying? It's pretty low. So they can put you in a group, offer an insurance plan, really cut down that price, and make it a very affordable option. But again, it's maybe one time your salary as opposed to 3 or 4 million that your family might actually need. So it's a striking difference in coverage. Okay, maybe I talk too much, but my next question is, why doesn't the insurance coverage from a W-2 job cover everything, and what are some of the limitations of this coverage?
So yeah, just kind of an extension of our last question. So, you and I both agree that group insurance is great. And if you have the opportunity to take advantage of it, you should, because it is going to be at a relatively low cost to you. You can have it, have the premiums taken out of your paycheck before it even gets to you. So it's kind of out of sight, out of mind, right? It's just automatic. And it can provide some amount of coverage to people who are otherwise uninsurable. That is a big benefit for group insurance. So if you're somebody who is maybe not super healthy, or you have tried to apply for life insurance previously and you were denied, well, you could get in and get some coverage at a group rate, right? However, like you said, most employers really only provide some multiple of your average annual salary. 1 to 2 times maybe. Really, some have a buy-up provision, and if they do, I would definitely recommend, and I know that you would as well, to take advantage of that. But it really doesn't protect your family to the extent that they need to be protected. And most of the time, if they're without the buy-up provisions, and even with the buy-up provision, it's still not going to get you to that 3 million or 4.5 million that you might need, or that your family might need without you around. And then the other thing is, it's not portable. It doesn't go with you. So if you lose your job, or you get a little disillusioned with your work and you're ready to make a move, you just have to be prepared to know that life insurance coverage that you had for your employer does not go with you.
Yeah, that's really important. I have a story of a client who I am currently working with, and now they're in their 50s, and they've been working for the same corporation for 20 years. So 20 years ago, when he was 35, 37, he decided to opt into their group life insurance and even pay for it to be multiplied. So he thought he was really making the best decision for his family, right? Which is, I'm not only going to receive 1 time my income, he opted for 7 times his income. So whatever his annual income was, they would pay out 7 times that, which sounds like a lot, especially for like a 58-year-old. Maybe that would make sense. But if you think of it this way, now he's 58 and he has health conditions. He has a heart condition and he might not qualify for a lot of independent insurance. And maybe you're thinking, well, he doesn't need to, he's already paying for it through his work. But the only way that his family would be awarded the money is if he is still employed with this company. So I mean, and that's how group health and that's how group insurance works. Life insurance works is you're paying into a term policy, and part of the terms of your agreement with that insurance company is that you're still employed with this employer who's giving you this offering. You're a part of this group, and the group is your co-employees, right? And if you're no longer in that group, you're not eligible for the coverage.
Absolutely.
So he would have, after 20 years of paying in on a monthly basis, or maybe even twice a month coming out of this paycheck, if he decided to move jobs, he has nothing to show for it. He has zero life insurance coverage, even though right now he feels really good about it because he's employed and he has 7 times his income. The only way he can use that money if he dies, if he's employed with that company. So to me, the element of being able to transport your insurance, like I know I'm covered no matter what happens to my career. And some people are lifers at companies, so that might not be as a concern. I'm not. I'm a small business owner. I want to know that I own my insurance and that I can change jobs if I need to, and the company can be bought and sold and the benefits can change, and who cares because I own my insurance and my family's going to be taken care of no matter where I'm at. So that's definitely something to think about because he technically made a very smart decision. 7 times his income. What a fantastic benefit. And it was very affordable for him, very affordable. But now he's sick and I can't get him qualified for an independent life insurance product because now he's ill.
Yeah. Yeah. It's unfortunate.
Yeah. Okay. So as a business owner, a lot of times we start our businesses not really thinking about the long term for our business, right? Like, okay, I'm just trying to get it up and running. I'm hustling, trying to get everything going. And, what happens really if I build up my business to where I really want it to be, and then I pass. I'm not the one running the company anymore. So, I know that life insurance can help cover that. So how does that process work?
Sure. Yeah. I mean, so I mentioned up above earlier that there are a couple different types of policies that a business owner should consider. And really, the 2 main ones that come to mind are having a personal life insurance policy, right? Just on you, that your spouse and your dependents are the beneficiaries of, and essentially that's creates a primary source of protection for your family to pay off any of the business debt. Cover their living expenses after your death, and ultimately provide them with more time to figure out next steps. It's like I said, it could be in a scenario where you're not really sure who in the family, if there is anyone in the family that is capable of or even wants to, do what you were doing, run that business like you were running. So there's just a lot of things to consider, down the road, and people don't obviously. Thinking about our mortality is not exactly the most fun thing to do, but it is prudent to do so in these scenarios because ultimately we all are going to pass at some point. We're going to have to punch our ticket, and at that point it's too late to make any of these decisions and put any protections in place. The second policy that I highly recommend for business owners to consider is having a buy-sell agreement. So the agreement itself isn't something that the life insurance provider or agent would actually put in place. That would be the attorney. But they are typically funded by life insurance. So that would be the primary source of protection for your company and an additional source of protection for your family. So essentially, with a buy-sell agreement, if your business has multiple owners, you can combine life insurance policies on each partner with that buy-sell agreement. And the agreement stipulates that on the death of one of the partners, the remaining partner or partners can buy out the surviving family's share at a previously agreed upon price, and the life insurance pays for that buy. those are really the two main policies that I recommend business owners have in place.
Yeah, and I think something important to realize as a business owner is your business can pay for these policies. So it doesn't necessarily have to come out of your personal income, your personal checking account. You can add that as an expense for your business and providing that long-term plan down the road. I think with the buy sell, yeah, if you have a partner or someone wants to buy out the business, initially, especially in the state of Arizona, with having community property laws, when you're, when you're married, if you have a partnership with someone you're not married to, like if I passed, my business would be passed to my husband according to community property law. And maybe, like you were saying, he doesn't want to take over, he's not equipped to, he's not interested, or he just wants to be bought out because the family needs the cash, or whatever the situation is. And so yeah, you'll give your partner that opportunity to buy the spouse out of the arrangement. And the nice thing about that is now that family has another influx of cash that they can, pay their regular bills with. And I think, yeah, that's looking down long term. What do you have planned for your business? Are you building a business that you want to pass on, that has lots of employees, that you feel like someone else can come up and be in leadership? And if that's you, you might want to think about some kind of insurance policy on the CEO, the owner of the company, whoever's, the front person, because you're going to want to pay your employees and pay for the expenses so that your business can keep going after you're gone. So there's lots of different options to do that. And I think people are getting more creative with how to like design those. And so we can, Charlie can partner with an attorney to make sure that it's provided the way that you need to for your business. Okay, so there's lots of benefits to life insurance and lots of different options here. I think people are realizing how many options there are. So, what other benefits do life insurance policies have outside of just a person dies, you get the cash, right? Are there other benefits than that?
That's right. Yeah. So that's why term insurance is dubbed the purest form of life insurance, quote unquote, because it really does just provide your purchaser, you're trading in your premium payments for a death benefit that will only be provided if you are to pass away within that term, whether it's 10, 20, 30 years, whatever the term is. Mm-hmm. So it's just pure life insurance. And I liken that to renting a home, instead of owning a home. So when you're renting, you're basically paying your rent every month for a place to live, get your shelter and whatever over your head. But when it comes time to leave, or when your lease is up, you either have to re-up your lease or you move on. And you don't have anything to really show for it, right? Yeah. But you have had a place to live. Now with cash value life insurance policy, whether that's a whole life or universal life, variable universal life, there's different forms. There are what we call living benefits. And that is just like the name that I mentioned before, first and foremost is the cash value. So a permanent life insurance policy, not only is the death benefit permanent, right? There is no term, that it doesn't time out on you. There, once as long as you're paying your premiums and however you set up your premium payments, sometimes it can be more of a short pay scenario where it's you pay into it for 10 years, but then you have a permanent death benefit, or maybe you're paying on it all the way through until you pass, right? All the way through retirement years. But regardless, that as long as you keep those payments in place and you keep the policy going, then that life insurance death benefit will be there for you at any given moment whenever you pass. So that cash value, it can be used as an emergency fund, right? It's something that you can use for an investment bucket for capital expenditures, retirement planning. You've got two purposes for $1, essentially, like you and I talked about the other day. You've got the death benefit plus, maybe the volatility buffer for retirement income. And essentially that I didn't mention this before, but accessing that cash value, if you take out a loan, when you access that cash, it is non-taxable to you, right? And you never really have to pay that back unless you wanted to. You can, right? If you want to put the money back in, and depending on what your use is for that policy, because there are great uses for cash value life insurance policy. It's just good that you can get into a lot more creative and concepts, and it gets to be a little bit more fun than just your average term insurance policy. But another one of those living benefits is in the forms of riders, especially in like long-term care insurance rider. So what that rider would do is it can just pay a little bit more of a premium, to have that rider tacked on to your policy. And what that does is it would accelerate some portion of the death benefit proceeds to be used for qualified long-term care expenses. Now, if you had, one caveat is that whatever funds are used towards those long-term care expenses, that same amount will be deducted from the death benefit upon your passing. So there is, it's not like you can't get your cake and eat it too, really, but you have two different, you got another use for that, for those funds tacked on with that rider. And I think you had a strategy that you wanted to discuss for emergencies.
Yeah, I think, traditionally people think of accounts as having 3 different ways to be taxed. Like that's how we're most familiar with it. So there's a taxable account, like your checking account, your savings account, any interest, which I know interest is practically zero, but any interest you have, you pay taxes on a yearly basis. Every year you pay taxes on that interest. And then there's a retirement account, which you put pre-tax money in, and then when you retire, all the money you take out, you pay taxes on as income. And then the third type of account is I put after-tax money into a Roth, and it grows tax-free, and I can access it later and not pay taxes on what I put in or the growth. So in those 3 situations, you're still paying taxes at some point, right? And so really, the fourth example is with life insurance, and this is written into the federal code, is life insurance is tax-free. So when you pass and the amount of money you decided, like your $3 or $4 million example, that money is tax-free. That's getting paid to the next generation, to your family to take care of them. But also, you're right, when you're taking a loan from the policy, and you pay it back or you don't decide not to pay it back, then that money is also tax-free, right? You're putting in after-tax money, and any growth, whatever happens in that cash account, you're taking out tax-free. So, I think, as a financial planner, when I'm looking at retirement, when I'm looking at helping people build wealth, from my perspective, I want them to have different ways of taking out money that are taxed differently. Because if every single dollar that you use in retirement is taxed, you're going to have to save at least 30% more than you might think, because that's how much taxes could be taken out, or more if taxes go up, right? So you can diversify a little bit by giving yourself another tax-free option. So not every dollar I pull, I'm getting taxed 30%, 25%, whatever your example is. And the other part is, I don't have to pull this money. So it's there like an emergency savings account. I can pull it when I need to. Maybe the stock market took a crap and I don't want to take money out of my stock account that year. Fine, I'll pull money out of my life insurance. Now it's not taxed, and I give my stock account more chance to recover. So there's so many life insurance strategies. That's just one of how you're diversifying your opportunity. You're giving yourself options. Life insurance gives you options. You have options to change your job if you own your life insurance and not be worried about your benefits. You have options to start a business and keep it going no matter what happens to you. You can leave a legacy to your family. Options. That's what I think about when I think about life insurance. So, yes, I'm
I wholeheartedly agree.
a pro life insurance financial advisor. Okay, so we did talk about this a little bit. Oh, I can share my IUL example if you'd like to. So
sure.
I own a policy myself, where if I die, my family would receive a death benefit. The other purpose of that account is to send my kids to college. So, every life insurance policy has the death benefit. So there has to be a conversation about what the death benefit amount would be. But in addition to that, you can have a different purpose for that cash account. It's a different way to save money. And for me, I'm looking for a tax-free way to save money, right? Tax-free growth. to help my kids go to school. The nice part about, like I said, life insurance is options. So there are some college accounts where I would be, you're married to the fact that your kid has to go to secondary education in order to get the tax benefits of that account. Well, I don't really want to be handcuffed. I want my kids to do what they want to do. And they might go to college, they might not. The world might look different in 15 years when they get there. So I want to be able to have the flexibility and the savings to do what I want with that money. So that's the purpose of the IUL, is to save for my kids to go to college and just not touching it, not touching it, not touching it. And then in what is it, 13 years now? That's scary. In 13 years now, my oldest could go to college, and I would have some money set aside to help that happen. I could take it out. And like Charlie said, every dollar that I take out of the cash account, if I decide not to pay back that loan, that's $1 less that I have for my death benefit. So that's how the loan kind of balances each other out. You can't really have the max death benefit and take all your money out of your cash, right? I mean, that would be way too good to be true, but
Right.
I can access my cash. It's just going to decrease my death benefit dollar for dollar.
Right.
So that's my example. Okay,
great
so
example.
thank you. So I could talk about life insurance all day, but there are other considerations we need to think about in protecting our income. There's other circumstances, not just death, right, where we might need to replace our income. So this is really much more your specialty than mine. So, so tell me about disability insurance.
Yep, sure. So oftentimes employers will, provide short-term disability for their employees, and those programs are, again, usually on a group rate. Sometimes they have group long-term disability as well. But for purposes of talking about short-term, it usually is a kick in for the first 3 months of a disability. Someone were to go on claim. So for 90 days, they would have a portion of their salary just paid to them, right, because they're out on claim. And then the long-term disability policy kicks in after that 90 days. So the long-term DI policy have a 90-day elimination or waiting period. And so for folks that don't have the benefit of a short-term disability policy through their employer, or if they were able to find one that they were able to purchase on their own, or they have another group scenario, they are pretty much going to be left with having to survive off of their emergency fund. So that's one of the reasons why people like us in our industry highly push and recommend is that folks have 3 to 6 months at least of an emergency fund, right, for situations just like this. But folks are the numbers are kind of staggering. I mean, it's interesting to me that most people generally understand life insurance and the need for it. They want to. It's a selfless purchase because it's nothing that you are going to benefit from. It's your family, it's your beneficiaries, right? Or maybe it's a philanthropic organization if you don't have family, or whatever. But it's not for you. You're long gone. But what's more of a selfish act, I guess, is having some long-term disability in place. And so, again, just like having a personal policy and want to protect the business, do the same thing with long-term disability insurance. The less than 2% of term policies pay out a death benefit. I mean, so if you think about that's basically saying there's less than 2% chance that you're going to die prematurely, right? But there's a 1 in 4 chance that somebody who's entering the workforce today is going to go out on a disability claim before they retire. So if you think about that, that's 25% chance. It's more than 10 times more likely that you're going to go out on a disability claim than you are for passing away prematurely, right? So a personal long-term disability policy would provide income replacement up to 70% of your income, and that would, like I said, protect against that 1 in 4 chance that you become disabled at some point. Another thing to mention here is that most people think about disability in the sense that, okay, well, what are the chances that I'm going to have such a bad car accident that I'm going to lose a limb, or I'm going to lose my eyesight, or something like that, a debilitating accident? Well, that's only about 10% of the causes that make up disability. We look at it from the numbers across the nation. Typically, the causes end up being musculoskeletal, like lower back pain, somebody's, they throw their back out, they've got knee problems, maybe they have more of a physical job and it's a shoulder, and they can't use their arm properly. So those tend to be, the number one cause. Then you have, of course, disease, heart conditions and cardiovascular disease and cancer and those kinds of things. So it's really musculoskeletal issues and diseases that put people out on disability claims and make that where they can't actually do their work. And then, like we've talked about before, in that buy-sell agreement, in that arrangement you have with your partners, if you do have partners in your business, it's smart to have a provision in that agreement that would cover disability as much as it would be to cover, the premature death of one of the partners as well. So you kind of want to look at it from, look at that buy-sell agreement from both standpoints, from the premature death, premature passing of a partner, as well as an untimely disability, where maybe they're out, for 3 years or 5 years or 10 years, and hopefully they can come back at some point, but maybe they're unable to come back at all. So, just to protect the business and protect that, protect the company from the deleterious effects of losing one of the, key person in the organization like that. Makes sense to include that in your buy-sell agreement.
Yeah. Yeah, I really like that example. I mean, disability insurance, I'm glad you came with the stats. You broke up a little bit, so I'm going to repeat to everybody that only 2% of term life policies actually get paid out. So 2%, right? But disability is 25%. 1 in 4. 1 in 4. I mean, I really had no idea it was that high. But you're right. There are so many things that can take us out of going to work. And maybe it'll be a little bit more flexible with people doing Zooms and being able to meet with clients that way. And maybe that'll help with people's work-life balance and all those things. But I also know a lot of people that are working more and doing more hours and sitting in a more uncomfortable chair and not having the right setup at their house and taking care of their kids more, right? I mean, there's a lot of things that we do on top of our daily work duties that could really, have impact on our health and take us out of being able to earn income, especially if you're someone who, again, you're a service-based person. I know so many people with service-based businesses that if I'm not, on and available and here to meet with my clients and sitting with people one-on-one, I can't make money. And if that's your business structure, if you're someone who's like making a product and you pay a manufacturer and you can make money while you're sleeping in your bed, that might be a different story, right? But there's a lot of service-based providers who would be completely taken out with a back issue or completely taken out with, any kind of diagnosis. So it's, it could be really important to replace your income. And you're right. So there's that waiting period of 90 days. And if you're someone who's taking your finances seriously, your business is prepared, you're going to have an emergency fund to pay your business expenses and your personal expenses for at least that long, at least 90 days. That's why the minimum is 3 months, right? Because it fits in here. You at least have your emergency fund for 3 months. Then you can replace your income at least 70%, right? So these things kind of fit together. But you can keep your business going. Hopefully you can recover and then, come back full time. So disability is a huge gap that a lot of business owners don't have. And unfortunately it's really common that something can take them out.
And Abby, it's a, if you don't mind my adding, there's a pretty big gap out there too for a lot of W-2 employees. And I know we're really focusing more on business owners here today, yeah. But even contractor or W-2 employees who do have disability their work, some things to consider there are that the policies generally from employers are going to insure up to 60% of someone's base salary. So let's say they are a base plus bonus sort of an individual, or that base plus commissions. Well, whatever they earn in the commission or the bonus would be not even in consideration for being that would be replaced. And again, the policy, it's not going to be portable because it's paid by the company versus paid by you. And then also because it's paid by the company on your behalf, that benefit, when it actually comes to you, will be taxable. It's a taxable income versus if you're paying for, on a personal policy yourself, you're paying those premiums with that tax policy. So to get taxed on the benefit would be a double taxation issue. Not that I would put it past our government to try to do something like that every once in a while, but
Yeah.
they don't do it. That is illegal, goes against the tax code. So there is no double taxation. So just thought I'd throw that in there, that even folks that are W-2 employees, maybe there's someone on this call that are thinking about becoming, business owners at some point, or just kind of dipping their toe in the water, but they have have a job that's paying the bills for now. It's also something to consider there. It's an important benefit to have. It's an important policy to have in place because, it's like you and I both said, the numbers speak to it.
Yeah, that's a really great point. Another reason to keep your expenses low, to keep your debt low, right? I think anyone who's heard me on this knows that I am conservative when it comes to debt, because for exactly this reason, you want to give yourself more options, not less. You want to have more flexibility, not less. And if something happens to you, if you're only getting 60% of your base income, I mean, that's a pretty significant drop. So
and taxed, so it's not even fully the 60%.
Exactly. Oh, it's 30% of 60%. Can you do that math real quick? Because I'm kidding.
60% of the time it works every time.
There you go. I like it. All right. So if anyone in the audience has any questions, I'll even look on Facebook if anyone has questions. This is about the time for that. We would love to answer your questions. You're going to have Charlie's information in the email if you're attending. Let me see if anyone has any questions. If not, I will make up more questions because I'm happy to talk about this. We've got about 10 minutes left. Is there anything else you feel like we could have covered that we didn't, that you want to end with?
I mean, for business owners, another thing to consider, this is not so much for, I mean, I guess it is protection more for the business than maybe more so for the business owner individually. It definitely has an effect on them either way, but something called key employee insurance, it's another policy that the owner might consider taking out on. Let's say they have sales staff of 10 people, and one of those 10, or maybe two of those 10, really do drive 80% of the revenue coming into the company. Well, those people would probably be considered key employees in that organization. And so to protect against the loss of those folks, whether that's from an untimely passing, I would hopefully not, but really even if they just move on, that's, you want to protect against that loss of their production. So key employee policy is something to, or key man insurance, I guess is what sometimes called, to key woman or key man, but that's another policy to consider for a business owner.
Yeah, that's a great point, and that leads to Tana's question. So, key man insurance is focused on there's a person in your business who, if they didn't exist, if they weren't a part of that business, you would lose a lot of your revenue. You wouldn't be able to pay for most of your expenses. And so key man insurance kind of highlights one person that you're going to be providing coverage for. So the business could pay, again, the business can pay for this insurance as an expense, and you decide, how much time you might want to, how much revenue they're providing. And then maybe you want to replace that revenue for a couple of months or a year, however you want to do the calculation, so that your business can continue to pay the expenses and you can hire new people or train new people or whatever you want to do. But you're highlighting one person. It could be an employee, it could be an owner, it could be whoever, a partner, and you want to provide a policy specifically on that person so that you can replace the revenue they're bringing to the firm. So I hope that answers your question a little bit more, Tana.
Yep, absolutely. That's a good explanation too, Abby. There's also one other item I was thinking of, and that's a golden handcuffs sort of an arrangement. If you're familiar with that term, but essentially, gold handcuff setup is so, let's say you have a high performing employee or somebody that they're really showing, earning their stripes and you want to keep them around, you want to incentivize them to stay around, or the company might take out permanent, in this instance, it's usually done with a permanent cash value life insurance policy because of the living benefits. It's just much more of a more enticing benefit to the employed. So the business takes out that policy, and let's say, I don't know, you can arrange it any way you want. Like perhaps that after 7 years of service or something, then the policy gets turned over and is now in ownership of that employee, and maybe the company still continues to pay the premiums on their behalf. Whatever, there's a lot of different ways to structure that, but the point is it can be used as an incentivation or incentive tool to keep high performers from leaving the company.
Yeah, that's great. I hope whoever is listening really can see that there are so many different strategies and so many different options when it comes to life insurance. Adding life insurance, adding disability. Maybe you're a business owner with employees and you're trying to offer group life to your employees to entice them to stay, right? There are so many different options. Personally, key man, business, for your family, all over the place. So I hope you got the message that it's important to talk to someone who is an expert like Charlie, so that you can weed through some of these strategies, talk about your specific situation, and he can help you find those areas that your business might be vulnerable, your family might be vulnerable, and then really provide the coverage that you can feel confident about. I can feel confident that no matter what happens, my family's okay, that my business is okay. And those are some of the conversations that like Charlie's really equipped to have, and he can suggest those strategies for you. So I think we're just going to close with Charlie's information. Again, I'll shoot this out to my contacts that if you're on the call, if you're live on Facebook, you can find an easy way to talk to Charlie and just begin the conversation. Please don't let pricing stop you. That's why there's so many different life insurance options, from term to IULs to whole life. They're priced very differently. And that's really Charlie's expertise, is finding the price that makes sense, the coverage that makes sense. That's what he does. So here's his information. And just go ahead.
I was just going to say thank you very much for having me on here today, Abby. I really appreciate it.
Oh yeah, I'm so glad you came on. So like I said at the beginning, there's 2 more weeks of the Small Business Summit. We switched the last 2, so if you notice, the agenda is a little different, but I'm really excited about next week. Next week, I'm actually bringing on my husband, Tom, to talk about marketing. So reaching your current clients, crafting a unique message to connect with your best clients, because we want lots and lots of your best clients. Who are your perfect clients? So we're going to talk all about that next week. And then the following week on the 23rd, I'll be talking about building wealth. So taking your business planning long term. I think I might have a guest on to talk about taxes too, and how that comes in. I know everyone loves saving taxes, right? That's all we want to do as a business owner. So join us for those. And thank you so much for your time. I hope you have a great Thursday, and we'll see you guys soon.
Bye.